Good afternoon. Welcome and thank you for joining HCM's call with Doug Johnson and Mike Hengehold. This is Maureen Everhart. Today is April 15th. Doug and Mike will discuss the details of the new federal stimulus program and the possible market impact of this program. They will also discuss the indications of a bottoming process and will address client questions that have come in. Your lines are muted. We ask that you please keep your lines muted and send your questions into our email box at info@hcmwealthadvisors.com. We will do our best to keep this call around 30 minutes. And with that, I will turn this over to Mike and Doug.
Hello, everybody. This is Mike Hengehold. Today we have HCM clients on board as well as clients from HGCPA, so we welcome everybody. The first thing I'd like to do as usual is start off with a positive focus. There's lots of things going on to worry about, so I like to start with sort of an upbeat note. And this is something I just happened to pick out of the news. An elderly gentleman named Lane McKeel, who had been stuck in his house with all the quarantine activity that's going on, had just picked up his disability payment and went to the grocery store, the Fresh and Low supermarket in Georgetown, Tennessee. He became distressed and pretty excited when he got to the checkout and found that he was $33 short on his bill, and he was just about to go back and have to put back some of these necessities when the young 17-year-old grocery cashier, Elizabeth Taylor, yes, Elizabeth Taylor, reached into her purse and paid the difference for him. And that made me feel good when I read that, and so I thought that was a good positive focus. Another positive focus, as I want to wish everybody happy April 15th. You do not have to file a tax return today, and you do not need to pay any taxes today, so I thought that was good news. One other thing I just saw in the news recently, and this is exciting for us, there was a victory for sustainability recently. According to data released by the International Renewable Energy Agency, the renewable power that came on board last year in 2019 accounted for 72% of all the global power generation expansion during the year. And the reason this is exciting for us is because, as many of you know, HCM helped in that effort by adding a solar array on the top of our office last year. In terms of real-life benefit, what we've been able to generate would have replaced about 43,000 pounds of coal, or about 1,100, the equivalent of about planting 1,100 trees. So we're excited about all of that. So that's it. My job is to deliver the good news. So now for Doug Johnson, who I'm sure has lots of wonderful things to tell us. Doug, of course, is the Director of Portfolio Management here at HCM. He'll give us an update on what's gone over the last week and some perspective about the markets. Doug, you're on.
Thanks, Mike. Can you hear me?
Yes, I can.
Okay, great. Let's go ahead and start with our weekly economic update. And unfortunately, my news is not as uplifting as Mike's, but necessary to report nonetheless. So, as we've touched on the jobs that have been lost over the past 3 weeks, we've reached up to 16 million jobs lost. And with the initial claims number that's expected tomorrow to be around 5 or 6 million, that would equal approximately 22 to 23 million jobs. To give you a perspective of what kind of number that is, it would erase essentially 100% of the jobs that we have gained since the bottom of the financial crisis. So when we talk about significant demand destruction in the economy, that should give everybody an idea. And as an economy that's grown to be very driven by the consumer, that is going to cause a significant headwind. We also saw retail sales numbers drop close to 9% today, which was, I believe, the largest drop on record. You also had the New York manufacturing indicator print at, I think, a negative 78. The consensus was for negative 35, and I think this goes without saying, but this was clearly the lowest print that we've seen. In addition to that, we've seen global downgrades of growth across the board from the major Wall Street firms, the IMF. They've all come out now and begun to reduce their global growth forecasts, and the numbers, unfortunately, the comparisons that you're seeing are to either the Great Depression or to the Great Financial Crisis. So growth is expected to slow pretty significantly here over the next quarter or two. We had the big four banks were the first kind of major headline corporations to deliver earnings over the past 2 days. And what I'd like to touch on here is something specific, very, very much to banks. I mean, the earnings numbers were down, and that was unexpected. But I wanted to discuss something called the loan loss reserves. So what banks have to do in their earnings statements is put any provisions for any defaults that they might expect from loans on their books. So, for instance, all the mortgages they hold, if they expect people to start to default on those loans, they need to add money to a separate account in order to offset that. Now, between the big four banks over the past 4 days, there's been about $24 billion in loan loss reserve increases. So that's a significant amount being put aside with the expectation that things are going to get very rocky going forward. I think you even had Jamie Dimon, who is the CEO of JP Morgan, basically saying that they were preparing for what would likely be a severe recession. So when we talk about concerns over economic numbers, these are the type of things that we're looking at. And again, it's not necessarily a surprise that the economy is struggling now that everything's shut down. But I think it's important to try to gauge what this looks like in a historical perspective, especially when we're doing this against the context of what's going on in the market and basically seeing this massive divergence between economic data and market data. So as we've seen, the market continues to rally. We're now back to levels that we were just 10 months ago on the S&P 500. So it shows that divergence in a very clear light. I mean, if you think about all of the things that we were faced with 10 months ago versus what we're facing right now, it's almost impossible to argue that the two things are similar, but that's what the market is saying right now. It's telling you that the conditions back then were similar to what they are right now, and that it simply doesn't compute. So in certain instances, if you look at valuation metrics, you could argue that the stock market is actually more expensive right now in a valuation standpoint than it was at its peak in February. So when we talk about valuation and you look at those metrics, when we're thinking about doing things like re-risking portfolios, you'd obviously want to do that at a time when valuations were attractive, as it would give you a little bit more margin of safety. But right now we're seeing still significantly inflated numbers. And it's not just a price dynamic. But with that said, this is a reminder that the rally we've seen, even though it's been extremely strong, it's still not anything that's far out of the normal for what we would see in a normal bear market rally. I think you've seen right around a 50% retracement of the peak to trough sell-off. So if you just throwing out numbers, if we got a 500 point decline, we've made about 250 points of that back up, or 50%, which is not abnormal to see in markets like this. I think what's happened is the time frame has been condensed, both on the down and the upside, and it's kind of stirred investor emotions a little bit more to where that fear of missing us going back to all-time highs is starting to creep back in, even though we're looking at an economic catastrophe right in front of our face. So as we've talked about, last week in the market insight that we just wrote yesterday, we think that the Fed has played a large part in this. And last Thursday, you got an announcement that was significant. It was significant in the information that was given, but it was somewhat historic in the sense that the Federal Reserve not only increased their lending facilities, another $2.2 trillion to try to support the payroll loans, but they also introduced a program that would allow them to purchase ETFs that contain junk bonds or high yield bonds. So, high yield bonds are companies that have a little bit lower quality profile, and therefore investors demand a little bit higher interest rate from those companies to lend them money. So there's a risk-return trade-off there that has historically been a place where prudent analysis and management makes sense. But now the Federal Reserve has basically said, we're going to go into that market and buy up those risky assets. So before it had just been, we're going to do government bonds, we're going to do mortgage bonds, we're going to do money markets, things that are more on the safe side that are going to ensure that the bond markets are functioning properly. Whereas this now is just pretty much going in and them saying, we're going to buy risk assets. And this, frankly, isn't doing anything to get people back to work or to improve the economy. It's simply a way to buoy asset prices. So naturally, the question becomes, if they can do this, why can't they go in and buy stocks? We haven't seen that yet. There's a lot of people, I think, that are anticipating that happens. But as you see the progression down the line of a government who has unlimited, or a government agency who has unlimited funds, in their own words, coming into the market and asserting themselves in risk assets, it really changes the scope of how we think about investing going forward. And do they have enough firepower to basically hold everything up in the face of some of the things that we're seeing? And it's only been 3 or 4 trading days since this has happened. But I think a lot of people are starting to ask those questions. Not only that, if that's the new normal going forward, then it opens a can of worms that I think is probably outside of the scope of this call, but things that I think that the people may have not thought about quite yet. And quite frankly, we've never had a market recovery before the recession even got started. So if you think about it that way, you can really see the divergence that the Fed injection has caused in this. So with that, I will pause and turn the call back over to Mike so he can share some of his thoughts.
Thanks, Doug. So just on that note, I think one of the things that we are seeing a lot of is speculation of what the economic recovery will look like. You regularly hear pundits on television say we need to get this economy going again. I think one of the challenges, and we talk about different shapes of recovery and things, one of the challenges obviously is that when we originally became defensive with our portfolios, we were anticipating a certain level of economic difficulties, economic slowdown, if you will. Now that we can kind of see the whites of its eyes, I think it's fair to say that the economic consequences are likely going to be substantially worse than we anticipated. However, as Doug's saying, we're being met with or the slowdown is being met with an opposing force that is pretty impressive, with central banks around the world trying to get things going. In our task of trying to place a value on securities, we need to translate that activity, those slowdowns and that stimulus, into what it will likely mean for corporate earnings. And so one of the things that you have to think about, there may be the capacity for recovery, but we have a very difficult time seeing a situation where if in 3 weeks all of a sudden distancing is all of the restrictions are pulled back and we are open for business again. How anxious are people going to be to get on a crowded airplane? How anxious are they going to be to go to a crowded restaurant, to a crowded stadium? These are all things that will have bearing on how quickly, even though the economy is empowered to go again and people are ready to open businesses, will business be happening at the same level? We think the answer to that question is no, at least until we have a vaccine that can make people feel safe. So as long as the specter of this virus is overhanging, we think a lot of the things that have slowed down or been forced out of business temporarily, cruise ships, things of that nature, are going to be very slow to restart. So that is some of the baggage that hangs over our head and why we have a difficult time seeing this sort of immediate snapback recovery. I had one or two other things I wanted to mention. The first has to do with required minimum distributions. Now, we've beat this up pretty hard on previous calls, so I'm not going to go through all the various planning attributes that are involved with these relaxed rules this year. However, if you or if your folks are required or were required to take these payments this year, we really encourage you to stop and figure out if there are planning opportunities open to you. So if you or your folks have already taken RMDs, either all of your RMDs this year or some portion of that, this week the IRS provided instructions on how some, not all, but how some of the unwanted required distributions can be undone. So if you or somebody in your family is in this situation, check with your HCM advisor or your HGCPA for more information. This is really important. It's a fabulous planning opportunity if your facts will allow you to take advantage of it. And unlike a lot of the other relief measures that are out there, this is not a matter where you have to have been adversely affected by the virus or economic consequences. This is just a blanket opportunity. So we want to make sure everybody's tuned into that. The other thing that I wanted to mention with regard to stimulus payments, and I guess this is more good news, is that the stimulus checks are going out faster than originally expected. The Treasury expects that a large majority of these checks are going to be in people's bank accounts by April 24th. So again, that's better than everybody expected. And again, as a reminder, you will receive these deposits via, or you'll receive this money via direct deposit into your bank account, and it'll be the same account that you would have received a refund into if you had that set up for electronic deposit, or your Social Security check if you receive Social Security. Now, if you weren't required to file a return in 2018 or 2019 and therefore didn't have these kinds of things set up, or if you don't receive Social Security, but you are expecting to receive a stimulus check, you can go to an IRS website and set up your bank account information and so forth. What we have done is we have provided the link to that IRS website as well as a link to a calculator that will allow you to guesstimate what your benefit will be. That link is on our website. So if you go to hcmwealthadvisors.com and click the Start Here tab, there's a button under there called Stimulus Payment Information, and that'll take you to those various websites as well as some other information about the stimulus benefits that are available. The one other thing I would mention, if there are any business clients on the line, we now have some experience, very active experience with the payroll loans, the payroll protection loans that are being made available. And what we're finding by working with clients is that it may be necessary for you to change your banking relationship if you bank with some of the larger banks. They're finding it very difficult to be able to process for a number of reasons. Some of it's volume, some of it's the way they're approaching the problem. The people that are finding success are working with community banks, and in some cases, those applications can go in a day rather than things that are being hung up at the bigger banks. Now, we know people who have indicated their request more than a week ago and still haven't heard boo from anybody. So that's just a piece of information. If you are working on that, you may find that helpful. The next thing we want to do is tackle some questions. Let's see what our time is. We still have about 10 minutes, so we've got some questions. The first one we will take is, let's see. Let's get a good one. Here's one that just came in. What are our thoughts on the safety of money market accounts as we move forward? Doug, do you want to take that? That kind of feeds into a lot of the bond things you've been talking about, or what?
Sure. So I think in the list of things that you don't necessarily have to worry about right now, I think money markets would probably be at the top of that with the current conditions. I think the Federal Reserve has stepped in, and this was several weeks ago, in kind of their first iteration of quantitative easing program, where they essentially said, we're going to do this at unlimited funding levels. So I think that is a main focus of theirs. I think that they see that as essential for the proper functioning of credit markets and money markets. So I don't want to sit on here and say they're 100% safe and you don't have to worry about anything. But under the current credit conditions that we're seeing, I would say that for the most part, you could feel pretty confident owning those assets right now.
Okay, thank you. Next question. I hope everyone is doing well and staying safe during this difficult time. I'm emailing you from sunny Spain, where we're seeing an improvement in the number of daily new cases. I keep hearing that there's a very good chance that a second wave of the coronavirus could return sometime in the fall. This will depend on how the U.S. and the rest of the world handles lifting lockdown restrictions and getting back to a new daily routine. How do we prepare for that when it comes to our investments? If a second wave does hit, if it does hit and we have to start the lockdown process all over again, how will that affect the stock market as well as the new buys we've made since all this began? Doug?
Well, I think to know the answer of that, we still unfortunately need to see how the first wave of this is going to go. I think based on the conditions we've seen right now with no vaccine and a massive amount of uncertainty on how the numbers will actually play out, I can't envision a scenario where you're going to see a second wave that's going to be a positive. You're starting already in Singapore to see a second wave of infections in their country and the quarantines being increased slightly. So I don't know that it would necessarily be a positive, but it's really hard to say. I mean, that's part of the reason right now that we've kind of remained in a cautious state, even though you've seen the market rally back because of the amount of just sheer unknowns that still remain with this, and I think that the things that we would want to see before we felt somewhat confident about starting to increase risk again would be a combination of certainty around the virus, either significant reductions in cases or some kind of containment, improvement in the economy. And again, it doesn't have to mean that we're going to sit and wait until we start to see growth again, but we'd certainly need to see an improvement in the negative headlines that we've seen out of the economy. And then I think the employment figures too. The first 50 to 75% of the jobs that were lost, I think it's fair to assume that those will get hired back fairly quickly. But what happens to the last 25% of that? Are those workers immediately hired back, or have we gone so far that we've now kind of figured out a way, assuming this goes on for a few more weeks, that we figured out a way to survive without that extra headcount? And I think that will be important to see what kind of shape recovery we get going forward. So so unfortunately, I don't see that as a positive, and I know that I probably sound like I give a lot of dire information, and I promise you I'd much rather be bullish than bearish because it's more fun to be bullish, but it's hard to be bullish when we see what we're seeing right now.
Yes, I would add to that. That kind of feeds into a little bit of what I was saying a minute or two ago, that there are these other things, these other unknowns that are weighing on the ability for the economy to, and therefore the markets, to experience a snapback rally. So it kind of adds into the question of, would you want to sit in a crowded restaurant or a crowded airplane? When you think about the monetary side and whether there's going to be additional investment risk, will there be a flare-up in the virus again later in the year, or if we relax some of these restrictions a little too early? That's one of the specters that we're dealing with. The other thing that I would add is, just as a reminder, we talked about early on in the first of these calls, but HCM has a pretty disciplined process in how we handle these decisions with regard to increasing or decreasing risk in the advance and defend portfolios. So the advance and defend, again, are the ones that make tactical adjustments around these market conditions when investment risk is elevated. And we also execute a very disciplined risk in the strategic portfolios, which are regularly rebalanced to take advantage of prices as they decline. So I think that process has a benefit if things did get better, and or if we completed the sort of the bear market checklist. Doug was semi-alluding to that a minute ago when he talked about wanting to see an improvement in the virus, improvement in the economy. Another thing we would talk about there would be sort of testing the lows of that waterfall decline. If all those things happened and we had gone ahead and added equity risk to the portfolio, we would certainly at least consider dialing that back again if conditions appear to be getting much, much worse in the fall. So that's something that we'd be open to. Let's see, what's the time? We have maybe time for just one more. Speaking of Doug being a downer, I was starting to feel somewhat relieved from this panic sell-off, and now Doug Johnson is full of doom and gloom. I was just beginning to feel like we were starting a gradual comeback. So here are my questions. When are we going to get back to normal, meaning a normal market? I'm happy with 5 to 6%. Is that going to happen in 2 years, 5 years, 10 years, or never? Isn't some of the bad earnings, et cetera, going to already be built into the markets? Is this like the unemployment numbers? They're obviously going to be horrible when the government prohibits you from going to work. Doug, do you want to take a first shot at that?
Sure. I'll try to be positive about this. But,
please.
So when the market's going to return back to normal, I wish we knew the answer to that. I think we can rule out never. At some point, it's going to come back, and we're going to see things get back to, I guess we'll say, more normal. We never may get back to the economic norms that we're used to, but I think we can expect at some point that markets will come back and function like we're used to. In terms of pricing in, that's one of the words and terms that to me is like literally fingers on a chalkboard when I hear that. Because, we talk about that all the time, bad news is priced in, this is priced in. If things were priced in correctly, then when the headlines hit, the market wouldn't do anything. But but it seems every time we've got one of these headlines popping, we've got, you know, a 3% rally, a 4% decline. So I think everyone wants to use that term priced in because it makes them feel a little bit better about the uncertainty. But in reality, I'm not sure how you price in 20 million, you know, people who are without work, you know, $24 billion in bank loan loss reserves, all of these things that are now being laid in front of everyone. I think we want to try to put it out of our mind, but then when it comes in front of us and we have to determine now, okay, how do we use this? It becomes a little bit worse. I think right now, yes, there is a lot of bad news that is being expected. I also think there's a lot of optimism that's being placed in the market right now too. I think a lot of people are pretty confident that we're going to get through this, that everything's just going to be up and running again, and or that even if none of that stuff happens, that the central banks will be able to basically plug this massive hole that we're seeing. Whether or not it actually works out like that, we'll see. But you know, I think that the idea of things being priced in, I would be careful with that term.
Okay. So I think that about does it for today. I think the net takeaway from that is, from our perspective, unless something happens to sort of complete the bear market checklist with all the unknowns that we have in front of us, you can expect us to remain somewhat cautious for a while longer. I want to thank everybody for joining the party today. Our next call will be in 2 weeks, Wednesday, April 29th. If something newsworthy pops up, we will certainly reach out and address that. And if you have any questions between these calls, you don't have to wait this long. If you've got something that's on your mind, feel free to call your advisor, and we'll get all those questions answered for you. Thanks, everybody. That does it for today.